Welcome to another edition of Financial Insights in Minutes, where we put your financial concerns front and center. Today, we're diving deep into the complex and often turbulent waters of the housing market.
Recent reports hint at alarming trends regarding property prices, crime rates, and economic policies affecting your investments. From California's rising crime to predictions that could reshape the housing landscape in 2024.
Today, you'll hear from experts and analysts shedding light on these pressing issues. So stay tuned.
We will be summarizing enlightening discussions you won't want to miss.
Let's get into the summaries of today's videos. First, Stephan tackles California's rising crime and homelessness issues with Mayor Phil Brock. Next, Reventure Consulting's Nick Gurley warns of recession after the anticipated rate cut in 2024. Sachs Realty's John Rubino discusses the impending housing crash and the economic bubble we're in. Real Estate Mindset highlights the panic spreading in the housing market due to declining demand. Jason Walter reports on an uptick in existing home sales, but what does it really mean for affordability? Finally, BiggerPockets analyzes the effects of Airbnb bans in major cities and the ongoing debate on affordability. Welcome to Stephan's YouTube channel. Today's topic explores a pressing issue: what's really happening in Santa Monica and California regarding crime and homelessness. Joining us is Phil Brock, the diligent mayor of Santa Monica, to shed some light on the dark clouds over our beaches.
Absolutely. Phil is on the front lines dealing with these complex issues. As someone deeply involved in local governance, he's uniquely positioned to share insights. Let's venture into this critical conversation.
What's the crux of today's urgent matter?
The core thesis reveals that California's alarming rise in crime and homelessness isn't just isolated to Santa Monica. It's a broader issue rooted in various policies across the state, particularly the handling of mental health and addiction challenges.
Let's unpack some of those key points, starting with the new crime bills.
The recent legislation aims to crack down on shoplifting by increasing penalties for theft above $950. Previously, the law allowed thieves to walk free under that threshold.
Now, moving to the pressing homelessness crisis.
Indeed, an overwhelming portion of police calls are about homeless individuals, often linked to severe mental health issues and addiction, rather than organized crime.
What's California doing about this issue?
The state has invested more than $24 billion in various homelessness solutions, but many initiatives have failed to bring meaningful change.
And how does Santa Monica fit into this?
Well, Santa Monica operates under its own set of regulations, making its battle against homelessness even more complicated. It's currently seeking state encampment resolution funding to tackle these challenges.
And what's the overarching sentiment regarding needed changes?
It's crucial for the community to advocate for long-term solutions that address root causes of crime and homelessness rather than just temporary fixes.
What predictions can we make based on this discussion?
New legislation could either curb crime rates through stricter penalties or fail to make a real difference if enforcement isn't consistent.
What about the response from the community and local government?
If residents engage more actively in these issues, it could result in a more cohesive and effective approach to solving California's escalating struggles.
As we wrap up, what are the big takeaways from our discussion?
In conclusion, the intricate layers of California's crime and homelessness problems demand a comprehensive reevaluation of state policies. Engaging as a community will be essential in pushing for meaningful change.
What can folks do moving forward?
Encouragement for viewers: engage in local conversations and support initiatives aimed at tackling these deep-rooted challenges. Your voice matters.
And lastly, what's the future looking like?
It's uncertain, but ongoing discussions and community support will play a crucial role in shaping California's response to these pressing issues. What do you think will happen next? Drop your predictions in the comments.
Welcome everyone to Reventure Consulting. Today's topic is gripping. What happens after the imminent rate cut by the Fed in September 2024? Will it lead us into recession fireworks? Buckle your life jackets, it's about to get turbulent.
Absolutely. We're diving into some meaty economic analysis here. Nick Gurley, the mastermind behind the insights we're about to share, has an impressive background as the founder of Reventure Consulting. Get ready for some serious data.
So what's the crux of Nick's message today?
The main thesis suggests that whenever the Fed cuts rates, it often precedes a recession, and Nick illustrates that with historical data showing a correlation between rate cuts and rising unemployment.
Let's break down some key points. First up, what do the historical trends tell us?
Nick highlights that about 70% of the time, when the Fed cuts rates, we see a recession shortly after. Out of the last 15 rate cuts, 11 led to significant economic downturns.
What about the current economic indicators, though? Are the signs already showing?
Definitely. Unemployment has spiked from 3.4% to 4.3%, which is alarming. Plus, there's been a 21% increase in the number of unemployed Americans in just a year.
Now that's serious. How's the housing market holding up?
Well, universal buyer demand seems to be cratering. Mortgage applications have dropped by 8% year over year, and there hasn't been any significant uptick in interest despite declining mortgage rates.
And what's the situation with asset valuations?
We're in a precarious spot. The stock market is currently valued at 200% of GDP, while the housing market is at 176%. Both are perilously high.
What can we foresee? What does Nick predict about the future?
Nick anticipates that as unemployment continues to climb, the economic environment will worsen. The housing market faces serious threats due to stagnant demand, potentially leading to a sell-off.
Any additional predictions to steer our viewers?
Yes, he suggests that the prospect of robust economic growth is under serious question. After the rate cut, investors really need to exercise caution as markets may not react as anticipated.
To wrap things up, what should viewers take away?
The big takeaway is to stay vigilant. The economic indicators paint a concerning picture, suggesting that things may get bumpy ahead. Planning ahead and staying informed is vital.
What do you think the Fed will do next?
We want to hear from you. Drop your predictions in the comment section below.
Welcome to Sachs Realty. Today, we're diving into the turbulent waters of the housing market with returning guest John Rubino, a well-known author and financial analyst.
Indeed. John has a compelling track record of identifying economic bubbles and has insights that could shape your understanding of the current housing crisis. Let's get ready to navigate these complexities.
So John, what's the crux of today's discussion?
The core thesis is that we are facing an everything bubble. The current housing market is about to see catastrophic declines with vast bankruptcies across sectors.
Let's break down these key points about the current housing market.
Absolutely. The housing sale rates are at historic lows, and we're witnessing a significant increase in inventory, which is putting downward pressure on prices.
And what does affordability look like right now?
Home prices have never been more unaffordable. Conversations with top agents reveal they're experiencing the worst sales year in decades.
What are the predictions for the near future?
There is a considerable chance we could witness panic selling as financial pressures mount, particularly in commercial real estate.
What external factors are at play here?
The geopolitical landscape is fraught, threatening to escalate tensions and dramatically affect economic stability across markets.
And what should listeners do to prepare?
Investing in tangible assets like gold and silver while ensuring you have a proper financial safety net is crucial right now.
What does John predict for the economy?
An impending recession is likely, influenced by a combination of consumer debt and commercial real estate failures.
And what kind of impact will this have on the housing sector?
Expect substantial price drops and many bankruptcies across sectors as the market corrects.
We've covered quite a lot today. What's the overall takeaway?
Stay prepared. Understanding financial literacy and having contingency plans will help navigate the expected downturn.
What should people remember about their trust in institutions?
Trust is dwindling in these times. Be cautious and informed about financial decisions.
What's the best way for our viewers to stay engaged?
Drop your thoughts in the comments below. Share your experiences with the housing market and how you plan to prepare.
Welcome back to Real Estate Mindset. Today's diving into some jaw-dropping news. Panic in the housing market. Are we in for a wild ride?
That's right. With recent updates suggesting things are about to get even worse, we're examining the latest data and asking the tough questions. Are real estate platforms like Redfin manipulating data to paint a rosy picture?
So, what's the big takeaway here? What's really happening in the housing market?
The core thesis is bleak. Panic is spreading due to a decline in demand and a rise in inventory. With prices potentially on the decline, the question remains, are we witnessing the calm before a storm?
Let's get into the nitty-gritty. What's happening with current demand?
It's concerning. Mortgage purchase applications and home buying searches have both dropped by 8%. If house hunters are back, it's sure hard to tell.
And how about the inventory situation?
We're currently sitting at 3.6 months of inventory. That's higher than we saw in 2017 and 2019. Sounds like the market's got some serious supply issues.
Moving on to pricing. What's happening there?
Price cuts are at record highs, and houses are sitting on the market longer, averaging 34.7 days. It's a tough sell for homeowners.
What about median sales prices?
Currently hovering around $390,000, but a decline is needed to match last year's figures. And remember, the revised numbers often tell a different story.
What about future predictions? What's on the horizon?
Foreclosure waves might hit if panic spreads, boosting the inventory and exacerbating price drops.
And how about buyer behavior?
Potentially, buyers might stay on the sidelines until they feel more confident in the market. Their hesitation could result in stagnant demand.
So wrapping it up, what should we take from all of this?
It's vital to stay informed and not rely solely on data providers. Transparency is crucial. Viewers, drop your thoughts below. Do you think data manipulation is afoot?
What's the call to action?
Empower yourself with knowledge. Check out home buying classes to understand the market better and make informed decisions.
Welcome back to the channel, sailors of the real estate seas. Today, we're riding the waves of a big report that just hit the dock from the National Association of Realtors.
That's right. This report highlights a rebound in existing home sales after a 4-month slump, and Jason's going to break down what that means for the housing market.
So what's the anchor point here? What's the core thesis from Jason's analysis?
Despite the uptick in sales, the report reveals that overall sales remain sluggish, primarily due to a long-standing lack of affordability in the housing market.
Let's navigate through those key trends. So what have we seen in the sales numbers?
The existing home sales went up by 1.3% in July, but are still down 2.5% compared to last year. Not exactly smooth sailing.
Ahoy! And how about those regional performances?
The Northeast is seeing gains, up by 2.1%, while the South faced a 3.8% decline. Talk about a mixed bag of waters.
Inventory is a key player. What does the latest data tell us?
Inventory rose by 8% from June, but we're still about 30% below what we had before the pandemic. Not a lot of cargo in that ship.
And let's tackle those pesky affordability issues.
Home prices are up 4.2% year over year, and with interest rates still high, many buyers are feeling the pinch. It's a tough market out there.
Now, let's gaze into the future. What are the predictions?
Sales may remain sluggish unless we see some substantial drops in prices. Plus, while rates may stabilize, ongoing price increases aren't making it any easier for buyers.
To wrap things up, what's the big takeaway from Jason's report?
Overall, the slight uptick in sales is promising, but the market is still facing significant affordability challenges that need addressing. What do you think will happen next?
What's Jason's stance on helping buyers?
He emphasizes the need for more incentives and affordability strategies to improve the situation. Viewers, what are your thoughts on this?
Welcome to BiggerPockets. Today, we're navigating the waters of short-term rentals and their impact on big cities. We're live from Airbnb's office in New York City.
Joining us is Taylor Ma, senior housing economist at Airbnb. He'll shed light on the current state of short-term rentals, their economic effects, and what trends we can expect.
So what's the core message from today's discussion?
The core thesis is that while short-term rentals like Airbnb can increase local economic activity, they may also contribute to the challenges of housing affordability, raising questions about their net impact.
Let's dive into the current housing market. How are things shaping up?
The market is still adjusting post-pandemic. Although mortgage rates are high, home prices keep appreciating, suggesting underlying demand persists.
What about the economic impact of Airbnb?
Airbnb guests alone contribute a whopping $85 billion to the U.S. economy, with 40% of hosts relying on that income to cover housing expenses.
Regulations are a hot topic. What have we seen?
In places like New York City, strict regulations have reduced available rental units without increasing long-term rentals. This indicates that many properties may simply remain vacant.
Looking ahead, what do you predict for short-term rentals?
As travel demand rebounds, we can expect growth in short-term rentals. However, regulations will likely adapt to address housing affordability.
And what about the balance of economic growth versus housing supply?
The economic benefits are clear, but without policy reform to increase housing supply, affordability challenges will remain.
To wrap it up, what's the bottom line?
While short-term rentals contribute greatly to local economies, a balanced approach is necessary to mitigate their impact on housing costs. Cities should focus on increasing housing supply to address affordability.
How can viewers get involved or learn more?
Comment below with your thoughts. What impact have you seen from short-term rentals in your area?
What do you think about the various insights shared today? The housing market's landscape is indeed shifting quickly.
Absolutely. We've witnessed both alarming predictions and hopeful signs in the discussions.
Each guest brought unique perspectives, yet they all underscore the urgent need for actionable reforms and understanding from the community.
Don't forget to comment below with your thoughts and experiences regarding the current housing market.
Thanks for watching Financial Insights in Minutes for August 25th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.